All right, let's get started. Welcome everyone to our second Economic Update webinar. My name is Chris Marty. I'm the VP of Data Analytics and Executive Education at MSCI. Briefly before we get started, I'd like to go over just a couple of housekeeping items. Many of you have heard these before, but just in case there are new people on the webinar, you're looking at a screenshot of the Zoom attendee interface. You should see something like this on your screen right now. You're listening using a computer system audio by default. If you'd prefer to join over the phone, just use one of the Zoom dial-up numbers to switch to telephone audio. You'll see those settings in the lower left on this slide. To minimize all background noise and other distractions, your microphone is going to be muted for the entire webinar, and likewise your camera is going to be off for the entire webinar. You will have the opportunity to submit questions to our speakers at any time during the webinar. And to do that, use the Zoom question and answer interface that you also see on this slide. As you ask them, we will collect them and address them during the Q&A session at the end of the presentation. So please ask questions. We like getting a lot of questions, and I know Rob and Elizabeth do too. So all of that said, I'd like to introduce Rob Wescott and Elizabeth Rust. Rob and Elizabeth are both economists from Keybridge Research, which is an MSCI economics consulting firm. Keybridge authors the quarterly momentum monitors that many of you are subscribers to, and we'll be seeing a new version of those shortly. Keybridge's mission is to be the most trusted source of analysis and advice on issues at the forefront of public policy economics. They serve as economists, policy experts, and strategic advisors to a diverse clientele that includes Fortune 500 companies, global financial firms, leading trade associations like MSCI, and other nonprofit organizations. So welcome, Rob and Elizabeth, and I'm going to turn the presentation over to you right now.
Hey, Chris, thanks. Hey, Chris, if you could go back a slide, we'll just kind of jump in and get started here. Or maybe go back one more slide too. I just wanted to, oh, I see.
Yeah.
I just wanted to say, so we're here today where we do consider MSCI to be a leading industry association, of course. So, and we're happy to have been working with you for several years now. What we're going to do is give I call it a summer 2020 update on where the economy is going. And I have to say, these are very strange times. We've had a pandemic before, like 1918. We've had really high unemployment before, like in the Great Depression in the 1930s. And we've had massive street protests before, like 1968. But we've never had all three at the same time. And I actually think there's not a coincidence. There actually is a reason why a lot of these things are happening at the same time, and it really does flow heavily from the COVID infection. So that's what we're going to talk about. And I have to say, we put the economy into a medically induced coma in March and April, and we're now seeing kind of the peak pain coming out in the data. I'd say the peak of decline of activity was probably mid-April to mid-May. And so the monthly data that we're getting, including the manufacturer's orders data that we got this morning, we're basically seeing the absolute low point of the like industrial activity and industrial orders and that kind of thing. We're going to talk about where the economy is going next, but we're right in the midst now of kind of the bleakest data. So we know that. Our goal today is to talk about these items: the global economy and evolving relations with China. We'll talk about the U.S. economic story. We'll get to a key question. Elizabeth's going to talk about, can government policy help keep the economy afloat? I think that's a key question right now. She's also going to talk about implications for the metals end-use markets. And we'll wrap up with a couple of takeaways, and then we're going to jump into Q&A. So That's our goal today. And let's jump on to the next slide, Chris, and we'll go right into where the global economy is going. And let's skip one more slide. This chart here just shows what's going on with purchasing managers indexes for both manufacturing on the left and services on the right. In a normal recession, manufacturing takes it on the chin and services kind of tend to skate through. And this situation is the opposite. Everything is being hit, but services are being hit even harder than manufacturing so far. The good news is, and we just got PMIs for manufacturing 2 days ago and for services today, and things are all moving in a better direction. So March was really bad, April was the worst, and now this data is coming out for May, and we're seeing a little bit of a rebound. All countries are still in contraction for both services and manufacturing, except for China. China's just broken over the 50 line, 50-50 line. That means expanding business as opposed to contracting business. But you see real points of pain, especially in the service sector. In Europe, we had service sector last month. The PMI was in the 11, 12 range, which is just an unprecedented number. I mean, that means basically even all services are just basically shut down. And those numbers are starting to show some revival. We still are at a point of high pain, but there has been kind of a sense that we've crossed the threshold of the period of worst pain for the global economy. If we can have the next slide, Chris. There's a lot of focus on China. China was kind of like 50 days ahead of us on this virus track. And so we're trying to see what lessons we can learn from China. And China is starting to recover. We see some pretty good recovery data in China, but even China is only at about 70% of capacity. And this is some data from the Financial Times, it's daily tracking data. And it's kind of interesting. You see on the right, they've got some data showing like power plant consumption is coming back and air pollution levels are coming back, still not back to where they were. Traffic is kind of getting more congested again. That's a good thing to see. But if you look at the far right, you see container freight shipments from China are only 57% now of where they were before COVID hit. And what that suggests is that the recession that we're seeing that's hit Europe and that's also hitting the US now means less demand for Chinese factories to make things. And so there's a lot of stories in March and April. The Chinese government dictated that people should go back to the factories, and they got back to the factories. There were a lot of photo ops of people back ready to make things, but export orders had collapsed. And so that's kind of what's hitting China right now. If you look at the bottom right, just one more thing that's kind of interesting. This is box office admissions to movies, and you see basically zero. There's just, people are not still feeling comfortable in China going out to a public setting to do something that's purely optional, like go to a 3-hour movie. Let's go on, Chris. One more thing. I used to work at the IMF, International Monetary Fund, and I was the editor of the World Economic Outlook. So I look at the IMF's forecasts pretty regularly. They came out a few weeks ago for their spring forecast. And I'm not going to pay attention to the details here. The point is that the IMF is now forecasting that almost all major countries around the world are going to have something like a -5 to -9% GDP story for 2020. And we think the US is probably going to be in this category as well. These are the kinds of numbers that we've only seen in the past in the Great Depression of the 1930s. So, you know, it is painful. Let's go on, Chris. One more thing I just wanted to kind of make an observation on from the global perspective. So next slide, Chris. We are seeing increasing frictions between the US and China. I think everyone knows this, you're reading these stories, but we think this is fundamentally changing a business relationship between China and the US. We're seeing changed economic relations, so we're seeing restrictions on visas, you know, fewer students coming to American universities. We're seeing export controls. We're seeing tighter scrutiny of FDI, foreign direct investment flows into China and into the US from each other. And we think that we really are going down a path of we're going to be seeing ongoing tech battles. We have 5G battles, we have semiconductor battles, and we think those are going to continue. And one more thing I just wanted to make people aware of is the phase one trade deal between the US and China is really melting down quickly. China pledged to buy $37 billion of American farm exports in 2020. And as of April, they bought 3.6 billion. So not just basically 1/10 in the first third of the year. They're going to greatly miss that target. And I think if you look at President Trump ramping up the rhetoric, getting ready for the presidential campaign, it's a lot of finger pointing at China. And even if you look at statements that Joe Biden has made, likely Democratic candidate, it's very similar to President Trump. It's very kind of adversarial with China. And so we think that we are going to be seeing companies continuing to shift supply chains out of China. I think that comes back to North America and Mexico, US, and the USMCA countries. But I think there's been a lot more scrutiny on security issues, you know, the whole PPE and pharmaceutical issues. They really kind of put a new dimension on trade. So it's not just, I say here, not just in time, but just in case. People are going to be increasingly like, I want to have reliable supply. So I think we can have some questions on that, Chris. I hope we do get some, but I just think that's just a reality. And the whole Hong Kong protest movement and then China cracking down the last week, I think this just kind of is another piece of evidence that the frictions are going to continue. Next slide, Chris. And what I'd like to do now is talk about the US impact. And before we do, I have a question for everyone on the phone call. I'd like to ask a special question. So we're interested in your views. Chris, can you put our Zoom survey on the screen?
Survey is launched, and we'll leave it up until we get plenty of answers, Rob.
So the question is this, it looks like the US will be classified as having had a business cycle peak in the fourth quarter of 2019. When do you think your business will get back to the same level of business that it had at the end of 2019? And so we've given you five choices here. One is it already has or it will in the next month or two. Second is by the end of 2020. Third is sometime in 2021. Fourth, sometime in 2022. And the last answer in 2023 or later. So if you could take a few seconds now and go with your gut. Tell us what you think.
We're getting a lot of voting.
Oh, that's good. I'm really curious to see what people will say on this.
I'm going to give it a few more seconds, and then I will share the poll. You'll be interested in the results, Rob. And there we go.
So no one said it already has or it will the next month or two. It looks like by far the peak answer was sometime in 2021. Elizabeth, I think we would have, that doesn't surprise us, does it? Only a few said by the end of 2020, about 13%, 20% said sometime in 2022, and as you can see, 8% 2023 or later. So I suspect the airline industry might be a 2023 or later, but anyway, that's great. Okay, thanks, Chris. That's actually quite helpful. So thinking about where the U.S. economy is going, I just wanted to just say, you know, recessions are painful, but we really do have some real uncertainties out there now. And these are the questions that are on our minds. First is just, we know travel, tourism, and leisure have been really hit hard. And so one question is, can they come back online fast enough before financial stress and bankruptcies really set in that sector? So that's one question. Another question we're looking at is oil prices. Can they go up high enough? We're in the mid-30s now, but can they go up high enough to prevent large-scale layoffs and bankruptcies among shale producers in the oil and gas sector? We know from 2016 that the pain in the oil sector really did spill into the manufacturing sector, so we're going to watch that. Another question is government policy. Can it prevent the worst of the fallout? We're going to have some discussion on that. And now we have this new question, is the street protests in US cities, how will they affect the outlook? So some new things to think about. Let's go on, Chris. And when I think about the U.S. economy, I come back to this basic accounting identity. Just this is what you learned in your introductory economics class at college. GDP is equal to consumption plus investment plus government spending plus exports minus imports. And I'm just going to look at the first two. By far, the most important ones are consumer spending and investment spending, including for this group. So let's go on to the next slide, Chris. These are a couple of the key things that we look at to determine consumer outlook. And you can see one is the unemployment rate, and it just spiked in the April data showed a spike to 14.7%. In 2 days, this Friday, we'll get the employment data for May. We don't know what that number will be, but could it be 17, 18, 19, 20%? Yeah, real easily. So that is one factor that kind of undermines consumer confidence. If you don't have a job, you're less likely to buy things. And on the right, you see the consumer confidence index. And this data was basically at record highs in 2018, 2019, before we got into COVID. And you can see it's plummeted. So these are some of the things we're looking at that shape the consumer climate. If you go to the next slide, you see the data that we're looking at. We're looking at weekly data here on the left. This is the Johnson Red Book weekly retail sales data. And you can see it just plummeted over COVID. Over the second half of March and into mid-April, it was down. Basically, it fell in half. There's been some recovery starting in late April. We started to see some recovery. We're still down 35% year on year. So we're watching that closely. And on the right, we have some data from Google mobility trends show where people are moving. Are they going out to go to retailers, going out of their house? And you can see, again, people just locked down after with stay-at-home requirements and as the virus spread and got down 40, 50%. And there has been gradual recovery in recent weeks, but we're still down like 20, 25%. So these are some of the things that we're looking at. So these shape the consumer. So we hit bottom, but still a lot of pain. If we can have the next slide, Chris. We also just wanted to give a quick update on investment spending. So this is really important, and we're going to get into this more, but investment spending is about 15% of GDP, and second most important component of the economy after consumer. And we are seeing a lot of pain in the investment sector as well. We're expecting to see a sharp drop in the second quarter of 2020. Oil drilling activity is down. A lot of fracking crews in the Permian have been laid off. At one point, it looked like 80% of the crews are laid off, and production is set for something like a 25, 30% reduction. We'll see what that shapes up at. Aerospace equipment is a point of pain in the economy. Boeing is, laying off a lot of workers, and orders are actually falling. Net orders are falling. There's more cancellations of plane orders than new plane orders these days. Heavy duty trucks are a point of pain. Class 8 trucks, orders for Class 8 trucks are about 90% down from 2 years ago. And one other example that's a component of investment spending is like LNG export facilities. These things are like $5 billion plants, and they basically, we pull the plug in terms of finishing these LNG export facilities. Are just examples of some of the pain that's spreading through the economy. One more slide, Chris. We also look at small business sector. Small businesses are about a third of all capital spending on new equipment and software. And this is the NFIB, National Federation of Independent Businesses. So these are small businesses. And you can see that their optimism, which had been very high in the last couple of years, has really been taking it on the chin because of COVID. So we are worried. That means small businesses are ordering fewer computers and less office equipment and furniture and that kind of thing. So we're going to keep an eye on that as well. Next slide. We pulling it all together. One of the things that we're looking at that we think is a good measure is the New York Fed has a measure of weekly economic activity. And this is designed to track the year-on-year change of GDP. And you can see before COVID hit, it was running at about 2%, which is about where we thought we were. The US economy was growing about 2% before COVID hit. And you can see there's just, fell off the table as we shut the economy down in March and April. There's a little bit of a recovery, but we're still running at, about 10, 11, 12% below year-on-year levels. we think we're going to see a bloody awful second quarter for GDP, probably on the order of -30, -40%, and could it even be -50%? Yes, it could. So that's one of the things we're looking at, a little bit of recovery so far, and we think as the economy opens up and as people come back to services, there will be improvement. But you know, this is something that we're looking at. And the next slide, Chris, we're now getting, I'm going to turn this over to Elizabeth to talk. We've talked about pain, so now let's talk about whether government policy can help keep the economy afloat. So Elizabeth, tell us what we need to know.
Thanks, Rob, for giving just you know, a high-level overview of where the macroeconomic situation stands right now and what that kind of means about the near-term economic outlook. One key question for understanding what the economic outlook will be over the next 6 months and then going into 2021 is the question of to what extent government policy can help keep the economy afloat, can help keep the bottom from falling out of the economy. As we know, business activity in a number of sectors has really halted and things are slowly starting to come back online. But there remains this question of how bad the kind of ongoing financial stress and bankruptcies are likely to be. And a lot of government policies so far have revolved around trying to prevent financial stress from really ramping up and prevent businesses from going permanently out of business. So in answering this, we'll talk a little bit about what policies have been undertaken so far and then consider whether they've worked. When we do that, we'll begin to get a picture of just, how likely it is that economic activity will really be able to come back online once things really open up again. So if we go on to the next slide, this is just a summary of a lot of the policies that have been taken so far on both the fiscal and monetary side. Here we kind of draw this dichotomy between bottom-up policies focused mainly on consumers and individuals and top-down policies focused mainly on businesses. When we look at bottom-up policies focused on consumers, worth remembering that consumer spending comprises about 70% of the US economy. So this is obviously an area worth targeting when you're trying to keep the economy alive. Even putting aside just trying to reduce pain and stress among American individuals. Most of the impulse here came through the CARES Act passed by Congress. First, there was the direct payments in cash to individuals, $1,200 to adults and $500 to children, just an immediate payment to try to keep consumers alive, keep them paying their bills. There was also an extra $600 a week given out in unemployment benefits in addition to existing unemployment insurance policies given out at the state level. Also expanded unemployment assistance for non-payroll workers. This is the first time that that was done, just an acknowledgement that there are a lot of gig economy workers and they need to be targeted as well as some state level policies, which obviously vary by state, but some have passed policies with a moratorium on evictions to try to prevent homelessness and things like that. So that's been where most of the bottom-up policies have come through the CARES Act. Business-focused policies have come through a combination of the CARES Act and Federal Reserve monetary policy. So on the business side, we had about $660 billion in small business loans through the Paycheck Protection Program, as well as emergency disaster assistance loans, an additional $270 billion in tax relief directed at businesses, and an airline industry bailout of $50 billion, as well as a number of new lending facilities through the Federal Reserve. So huge variety of policies undertaken in the last few weeks, unprecedented actually in how quickly they were passed, even faster than during the economic fallout associated with the Great Recession. And if we just kind of considered how big they are, if we go on to the next slide, just looking at the fiscal side, one way of considering how big the fiscal impulse has been, this is the $2 trillion passed through the CARES Act, as well as the phase 1 and 2 smaller bills passed prior to that. The Congressional Budget Office did an assessment of what the impact on the debt has been associated with that legislation. And they calculated that in their April estimate compared to their March estimate, the 2020 debt to GDP rose by 20 percentage points and will rise to 108% debt to GDP by 2021. Now, this is a reflection not just of the size of the spending bills, but also the decline in GDP that we know is going to happen this year. So that affects both the numerator and the denominator. That's why you get such a big increase in the debt burden. I won't get too much into what the effects of a rising debt to GDP level will be on the economy. That's maybe something we can talk about in the Q&A. But this is just to illustrate how big the fiscal impulse has been and how quickly Congress acted to get money flowing into the economy and help prevent the bottom falling out. If we go on to the next slide, we'll start just considering how effective these policies have been. I'll start with the business impacts, the top-down policies with a focus on the Small Business Paycheck Protection Program. So as many of you may know or have read about or potentially even applied for a PPP loan, the Paycheck Protection Program put aside in the end about $660 billion in small business credit that small businesses with fewer than 500 employees could apply for in the amount of up to 10 weeks of payroll costs. If then the business spends at least 75% of the funds toward maintaining payroll and actually maintains all their workers and doesn't lay anyone off, then they will be able to qualify for loan forgiveness. If we look at kind of notwithstanding all of the news about administrative snags and hurdles and difficulties businesses have faced in applying and receiving the loans, if we kind of look at the headline numbers in terms of impacts of the Paycheck Protection Program, it looks successful, at least on the surface. PPP has paid out over $531 billion to over 4.2 million small businesses across the US, which is about 85% of all small businesses in the United States. So just successful in terms of, in the end, most small businesses have been able to apply for a loan and gain some funding. If you look beneath the surface, however, there are still a number of vulnerabilities in the small business sector, which will likely have an impact on the economy going forward. So one is just regional disparities in the distribution of funds. It's kind of interesting if you look where the funding went by state. Most of the funding relatively ended up going to rural Midwestern states like North Dakota, Nebraska, which obviously those businesses, many of them were forced to close and faced a big decline in revenues. But relative to other states were among the least affected by the virus. Many of those states didn't even have stay-at-home orders. Non-essential businesses weren't forced to close. If you compare that to New York, a much lower share of eligible payroll went to New York State, implying that many small businesses in New York State, where the virus was the worst, have not been able to access those funds. A number of reasons for that. Some of it is simply that small businesses in rural Midwestern states tend to have a stronger relationship with smaller community banks, which were able to process the loans faster. But it also points to the second bullet point listed there, which is the issue of fear of failure to qualify for loan forgiveness. So some of the hardest hit businesses may have not applied for a PPP loan, worrying that they wouldn't be able to maintain payroll anyway, that they would eventually be forced to lay off staff, and therefore were too afraid to apply for the loan. So counterintuitively, the funding may have actually gone toward the strongest businesses that have been doing fine rather than the businesses worst affected. There's also the issue with the structure of the program, since it was intended to make businesses maintain their payrolls. Many businesses face costs beyond payroll, including rent and equipment and all of that, and there's still a lack of financing for a lot of those needs. As a result, if you kind of consider some of the stats on the right, we know that many businesses were really hard hit. An estimated 45% of small business nationwide closed at one point in the last couple of months. We think at least 2% have permanently closed. And then, if you kind of consider that, it might look like most small businesses are hanging on, and it seems they are for now. But then considering survey data about likelihood of closing, the numbers look pretty grim, with about a quarter expecting to permanently close in the next 2 months if things don't start to really turn up, and up to half expecting to permanently close in the next 6 months. So looking at all of this, it looks like PPP has helped small businesses hang on temporarily, but it was never really intended to help businesses extend their life beyond July or so. So there's still a lot of vulnerabilities here. If we consider the consumers and individual side and households, going on to the next slide, somewhat similar story in that it looks like consumers are kind of hanging on for now. Just one way of looking at that is rent payments, where there was a lot of worry and consternation about whether people would be immediately falling behind on their rent payments. It's actually not the case so far. 90% of renters were able to make full or partial rent payments in May, which is just a slight downtick from a year ago, indicating that those immediate cash payments and the expanded unemployment benefits have maybe allowed households to hang on for a bit longer. But if you look forward, again, at survey data, only 61% of renters have expressed moderate or high confidence that they'll be able to pay rent in June. So it just, as the farther out you look into the future, the more things start to fray. Similar kind of story on the credit, consumer credit side, where credit card spending has gone down by a lot. So you might think that people would be better able to service their debt, but in fact, delinquencies are rising. This is actually kind of implied expectations of not being able to pay the balance, not the actual delinquency rate, but in any case, that's going up very quickly, implying that there's stress in the consumer financial sector. So again, it looks like the CARES Act has done a lot to keep people hanging on for a while, but without continued assistance going forward, potentially in the form of an expansion of unemployment benefits or other measures, things may start to turn negative over the summer. Going on to the next slide and considering Fed policy, the Fed has likewise pursued an unprecedented range of new policies, even sort of faster and bigger in magnitude than the CARES Act. You see on the left just all of the new lending tools and facilities that have come out. Most of those are brand new and didn't even exist before a few months ago. A few of them have been revived from the Great Recession. One thing worth noting is that a lot of this Fed action has already just clearly led to positive outcomes in terms of restoration of financial market confidence. So as soon as the Fed announced all these new facilities, we saw bond spreads over the risk-free rate immediately begin to decline in late March, a sign that markets viewed these tools positively and expected that they would help to shore up the plumbing of the financial system. Again, going on to the next slide and just considering the magnitude of this action, just looking at Federal Reserve assets, so the size of the Fed's balance sheet. In just the last 2 months, the Fed has added $2.4 trillion to its balance sheet, which is greater than the total size of its balance sheet after QE1 in the early days of the financial crisis in 08-09. Which at that time was considered an unprecedented move by the Fed, and we are just way beyond that. Also interesting to note in this chart how little the Fed managed to pull down the size of its balance sheet in 2018, which it was trying to do to help shore up for a time like this. It managed to pull it down a little bit, but financial stress began to set in, and it sort of halted those efforts and now has expanded its balance sheet even more. So again, huge unprecedented action on the part of the Fed, and it looks to be working in some ways. So if we go on to the next slide, what's interesting to note actually is how quickly market confidence was restored despite the fact that many of these facilities have not even been fully set up yet and or are pretty underutilized. So this is just kind of a summary of all these facilities, and you can see the bar indicates extent of usage, so how much of these funds have actually flowed toward borrowers and businesses. And then there's the shaded bar indicates the Treasury backstop. Just if you zoom out, you get this, the sense that there's pretty low usage so far for most of these facilities, in large part because many of them are still being set up. So, you know, that tends to imply that there's a lot more room to run in terms of credit that can be extended to businesses over the next several months. At the same time, the market has already responded. They might be already pricing in the assumption that this credit will be extended. So it may take the Fed doing more to continue to restore confidence if there is another sort of drop in confidence over the next several months. So again, all told, it seems that government policy has done a lot to prevent the worst from happening so far. It's kind of amazing that, you know, if you even just consider the small business figures, 45% had to close at one point, and still only 2% have closed permanently as far as we know. However, if this is not followed up soon with potentially more policies or just a big upswing in economic activity, we may start to see a lot of financial stress and bankruptcies setting in starting this summer. So going on to the next slide, Rob will kind of summarize, taking all that into account, what things look like over the next few months.
Thanks, Elizabeth. Yeah, so bottom line, we see about a 6% decline in GDP in 2020. So that's our kind of midpoint estimate here. So basically, really steep drop in GDP in the first half of 2020, followed by a gradual recovery. So our estimate is kind of similar to what you said. We think it's going to be at least another year until we see the level of GDP be back to the level of fourth quarter of 2019. We see lower consumer spending. I actually think housing starts are not going to go down anywhere near as much as they would in a normal recession. I think they're kind of one of the better sectors in the economy. I think CapEx is going to take it hard. I think we're going to see about a 15% decline of capital spending in 2020. We know we're going to be seeing more job losses. We know we've had about 40 million job losses March to June. We'll see where the unemployment rate is on Friday. It's possible that that will be the peak of the unemployment rate, or it may well be 1 month later. It may be the June data that comes out in July will show the peak unemployment rate. And obviously we're going to have zero interest rates for a long time to come here. So let's go on. And Chris, one more thought. You know, this minus 6% forecast, it could be better or it could be worse depending on some public health developments. And just wanted to share some of our thinking. What could make it better? Like, what could make it not be as negative in 2020? Well, if it ends up that the virus really doesn't spread in the summer, and we really have a real sharp decline of virus, I think that could easily make it be less negative in 2020. Another thing would be if we have even faster ramping up of testing and contact tracing, those sorts of things, that could make the economy not go as negative. And one more thing would be if we had a vaccine announced. I actually think that if we had a vaccine announced, even if it was, say, announced in August or September, even if people weren't going to get the shot in their arms until October, November, December, I think just knowing that a vaccine was proven to be effective and safe and that was coming, I think even that could restore confidence. So those would be some things could be on the plus side. On the minus side, things that could make it even worse would be if we really start to see state and local governments having layoffs. So state and local governments have to have balanced budgets by law. And the average state's going to see about a 20% decline of their tax collections, their revenue collections in 2020. So that's less sales tax revenue, less income tax revenue. And if we start to see layoffs, contracts canceled by state and local governments, and we start to see layoffs of state and local workers, that could, I think, could make another 2 points lower in GDP. If we see a second wave of COVID over the summer like that, I think that would really undermine confidence. That could be another big minus for GDP. And one more thing we're looking at is possible failures of regional and community banks. The largest 5 or 10 banks I'm not worried about. They have very deep capital bases, so that's not really a concern from my point of view. But I am worried about regional and community banks. A lot of the pain really is focused on small businesses, and many of these smaller banks are heavily exposed to small business. So those are just some considerations. We can have Q&A on this, but just a few thoughts. Next slide, Elizabeth, you're going to tell us what it means for metals, right? and markets?
So now that we have this kind of broad picture of the state of the US and global economies, you know, as you guys probably realize, if you look at things like, you know, metal shipments, the data from MSCI and just the broader metals industry as a whole, it moves very much with US GDP and industrial production. So when we talk about all this and a negative 6% decline in US GDP potentially this year, it's obviously not a good story for demand for metals overall. But that headline number kind of masks some issues going on in individual sectors. And so we'll spend a few minutes talking about some important points there. So if we go on to the next slide, I'll first just run through a couple of key sectors that are really worth thinking about and watching over the next several months. So beyond GDP and industrial production as indicators to watch, probably the next most important is simply the WTI spot price, oil prices. Because the oil sector, just the metals industry is so embedded in oil industry supply chains with so many metals industry actors and businesses supplying to the oil sector. As you may remember, we've seen a lot of turmoil in oil markets and volatility in the WTI spot price over the last several weeks. So at one point in April, oil prices dropped quite a bit below zero, even for, you know, not for very long, but a very weird development, the first time in history that oil prices were negative, which if you try to interpret what that means, basically implies that producers were paying people to take the oil away from the production site. That's how much oversupply there was. On the right, we describe a little bit of sort of what led to that. Fundamentally, what causes it, kind of putting aside, you know, prices are set by supply and demand, and there's this whole issue of production cuts and whether OPEC Plus is able to kind of orchestrate a cut in production. A lot of that was just failure of OPEC Plus to control supply. But the immediate shock came a lot from just the hit to global demand for oil due to the economic fallout associated with the virus. Kind of one key point to consider is that as long as global economic activity remains subdued, it's going to be very difficult for prices to come back up in a sustainable way. And a lot of the recent surge we've seen in prices is more of a function of successful production cuts than actual, you know, an actual surge in demand for oil. It's worth keeping this indicator in mind for just understanding where the metal sector is likely to go. Just given it, like over indebtedness in the shale sector and the fact that shale producers need probably oil in the $45 to $50 range to even cover costs. So that's their estimated break-even price. At $35 a barrel, things are heading in a good direction. But they're still well below that estimated break-even price level. And again, as long as global economic activity remains subdued, it's not, it's unlikely to remain sustainably there. Any kind of expectations to the downside in terms of successive production cuts or too many producers coming back online too quickly is likely to see an oil price decline again. I suspect we may be seeing that again soon because there's evidence that a lot of producers are coming back online quite quickly. They're fighting for their lives right now. They're trying to take advantage of $35 per barrel oil. And so you may see kind of a short-term increase in activity in the oil sector that could then be met with another decline as too many producers come in an environment of continued low demand for oil. So a lot of turmoil in the oil sector that will take a while to sort itself out. If we go on to the next slide, looking at the auto sector, likewise, a pretty shocking and depressing story. Car sales collapsed in March and April to their lowest level in modern history. As you can see, they're just below the level it collapsed to in the Great Recession. We don't have the full data for May yet, but early indications suggest that car sales continued to decline in May, but the decline slowed. So the decline is potentially bottoming out. It's worth considering that the decline is probably mostly due to simply the closure of car dealerships during lockdowns and the closure of non-essential businesses and those policies. So in that case, it's simply that people who maybe were intending or hoping to buy a car in the spring had to put those plans on hold, in which case they might buy one in the summer once their local dealership opens up again. If that's the case, then there's reason to be optimistic about the outlook for car sales and the potential for a V-shaped recovery in the auto sector. But it depends a little bit on some of those issues I discussed earlier with respect to consumer financial stress. I didn't go into the auto loan story, but there's obviously, a lot of evidence of financial stress in the auto loan area and auto lenders being reluctant to lend to consumers in an environment of just economic turmoil and high unemployment. So that's certainly a negative factor weighing on demand for cars going forward if, many consumers simply can't qualify for an auto loan. One plus side, however, for demand for cars worth considering, if we go to the next slide and we look at real-time mobility data, this is for the total US economy, based on Apple Maps routing requests, you can get a sense of how people are choosing to move and the extent of the decline in mobility due to coronavirus. Obviously, as you can see, we saw a huge collapse in just general movement in March as people were under stay-at-home orders or simply opted not to go out. And that's been coming back up as things are starting to open up again. But you can see it's recovering much more quickly for driving and walking than for transit. People are feeling comfortable getting in a car, maybe going on a weekend road trip, but they're not ready to get back onto a bus or a train. So as we look at the summer and just medium-term demand for cars, that may be a plus factor in the auto sector's direction. People looking to buy a car as they expect to use that much more than other forms of transportation. Conversely, if we go on to the next slide and consider the outlook for commercial aircraft, another pretty shocking and negative story there, non-defense aircraft orders have likewise collapsed to their lowest levels in modern history, with cancellations exceeding orders by $8.5 billion in April. That's why it's gone negative. These are net orders. So when cancellations exceed orders, we see collapses like that. And this is, again, due to just a collapse in global air traffic. But unlike for the auto industry, where car mobility is starting to tick up again, if we go on to the next slide and consider real-time data on global commercial flights, that looks a lot more like the curve for public transit that we saw on the previous slide. It's bottomed out, but it's coming back really, really slowly. There remain a lot of global travel restrictions in place on top of just reluctance to get on a plane, fear of the virus spreading on planes, many event cancellations, just making it so that there's no reason to even get on a plane if that business conference is not happening anymore. This is likely to take quite a while to recover, and this is the fundamental factor underlying demand for aircraft, even though the aircraft sector has kind of a longer order timeline with orders preceding shipments by quite a lot. In the end, if there's the expectation that flights will take a long time to come back, orders are also going to take a long time to come back. It's worth considering that after 9/11, it took about 3 years for global commercial air traffic to fully recover. In light of everything going on, it's probably reasonable to suspect that it will take at least that long this time. So unfortunately, not a very positive story for aircraft. If we go on to the next slide, I've summarized just all of the 10 end-use markets that Keybridge covers under the momentum monitors. Those will be coming out next week. So at that point, we'll have a fuller picture about the near-term outlook for each of these 10 end-use markets and understand in a little bit more detail what indicators are driving the outlook for these sectors. But I did want to give a preview. They're not going to look pretty. Most sectors are showing pretty serious contraction and a negative near-term outlook, but there is some variation. One potential upside area is construction, which has not turned down quite as much as you might have thought a couple of months ago, in large part because it's been determined or understood that construction activity can continue under social distancing measures and protocol, and that you can keep building during this time. The issue is simply demand. One thing, if we go on to the next slide, We've given a different impact score for non-residential and residential construction. Housing activity was kind of in the middle of an emerging renaissance right when coronavirus started. Housing starts were surging until the virus hit. That's somewhat due to the fact that there's not significant overcapacity in the housing sector, and there's still just a lot of underlying demand for housing. The question is simply, can consumers continue to qualify for mortgages? But the downturn there probably won't be as negative as for non-residential construction, where there is good evidence of overcapacity. And if you consider just potential depressed demand for office space, retail space going on for even a couple of years down the line, as well as probably a collapse in state and local government investment in infrastructure, that's certainly a more negative story than for the housing sector. For the others, I have a little bit written about the reasoning, but if you're curious to know more about what's going on in that sector and you subscribe to the momentum monitors, stay tuned and take a look at those next week. And then I think we'll go on to the next slide and just have a quick high-level summary.
Yeah, so Chris, the last slide, just to summarize, and we'll get into Q&A, but serious global recession has taken root. I think we know that. It's China's forging a recovery path, but it's struggling with weak exports. The US, we think the bottom will be hit like in the second quarter, like right now, and we think the third quarter will start to show recovery. But we still have to watch, especially we got to avoid large scale layoffs like in state and local businesses. We're worried about that. And then in terms of this group, I think manufacturing, which normally would take it on the chin in a recession, it's going to be down and painful in a recession. But I actually think some of the human contact service sectors are going to be worse, even than manufacturing in 2020. I think some of the more painful sectors are going to be heavy duty trucks, aerospace, businesses that supply oil and gas. I think defense should do pretty well. And I think home construction, as Elizabeth said, will probably avoid a sharp downturn. So Chris, let's stop there and have some Q&A. And maybe, I'm sure we've said something that someone wants to object to or follow up on. So please.
I think clarify would be the right way to phrase it.
Clarify, of course, clarify.
So there are a couple of questions that relate, Rob, to your earlier comments about China. One of them that came in immediately was your reference to just in time versus just in case. Could you tell us what is causing that change? Is it politics, or is it the view of domestic manufacturers here that are making changes to their supply chains?
Yeah, I think it's actually a combination of many factors, Chris. Fundamentally, microeconomic factors have been shifting with China. So China used to be 50 cents an hour labor cost, then $1, $1.50, $2.50. And China had basically gotten to about $5 an hour for labor costs. And at $5 an hour, it was cheaper to make something in Mexico. It was cheaper to make something in Vietnam, where, in Vietnam wage costs are $3, $3.50 an hour. So first of all, China was getting to a point because of its rapid economic development where its labor costs were getting quite high. So I think that was the first thing. I think there's been a political heat between China and the US the last 3 years, and President Trump has been, all the tariffs and everything that people have seen the last 3 years. I think that spooked some businesses to say, we get whatever, routers, we get components and things that we need from China. Why take the risk that we might have a 25% extra cost on this? We can make it in Mexico cheaper. So I think that has been a natural shift. But then I think the COVID-19, with the idea that I might not be able to get masks or PPE or pharmaceuticals or reagents and other things, I think that's helped tip the balance for additional firms to say, let's really look hard at shifting supply out of China to Mexico or back to North America somewhere. So I think it's a combination of things.
Okay. Next question is a kind of a combination question for Elizabeth. In terms of stimulus going forward, because Elizabeth, you mentioned that a lot of the stimulus expires, or, at some point July. Some of it hasn't really even kicked in yet. But if you had to choose only one stimulus going forward, would you choose to extend unemployment out past July, or would you extend the incentive for businesses to get their employees back to work? Which would be the most effective?
Yeah. So traditionally in a recession, the answer would be unequivocally the latter. You want to get people back to work. That's the economic activity and production that helps just create demand multiplier effects throughout the economy. Better to be paid doing something than to not be doing something. It's more complicated in this time because, of course, of the virus. If there's a risk that pulling everybody back to work and getting them back into their workplace is going to facilitate the spread of the virus, which leads to a greater economic downturn later because we then have to shut everything down again, that's when it's not so clear what the answer to it would be. I saw the way the question was phrased, and I think there was a point about can't split the baby. And I think that's actually some of the problem that has emerged in the combination of policies that have been put in place, because you have, on the one hand, expanded unemployment benefits, in many cases, people being paid more to stay on unemployment than they would to go back to work. So not too surprisingly, why work for less money than when you're on unemployment? So people stay there. At the same time, with the Paycheck Protection Program, businesses have to keep their employees on payroll in order to qualify for the loan forgiveness, but they can't do it because their workers prefer to be unemployed. So in some sense, you had those two policies working against each other, not really clear about whether you were trying to incentivize maintaining the employer-employee relationship and getting people back to work faster, or whether you were trying to incentivize keeping people at home so that the virus wouldn't spread. I think it's not simply that policymakers were stupid and didn't foresee that this might be the case. I think it's just simply that it's difficult in this time when there's so much uncertainty about the virus itself to know about whether it's a good idea to get people back to work. So my sense is better to get them back to work, but has to be done in sort of a cautious way and have backstop measures in case there is a virus resurgence, potentially in the fall, maybe as cool weather comes back in. So it's a complicated question. Again, better that people work, but it has to be done safely, obviously.
Okay, one more question. We've got a lot of questions, and unfortunately, we're going to run out of time. But can you speak, Elizabeth, this is to you again, can you speak to the effect of all of this stimulus in the long term? The government has pushed a lot of money into the system, and the Fed is about to do more. What is the downside of all that? Is it inflation in the future? What might happen?
Yeah, the short answer is no one knows for sure. The issue with expanding debt in general, not even just public debt, but debt of any kind in an economy, is simply that you expose yourself to future risk in the event that there's some kind of financial crisis later, a fall in confidence, a supply shortage that leads to inflation. It's sort of like pouring fuel on a dry branch or something and waiting for the day that the fire takes to light. We don't know when it's going to happen, but it's something worth worrying about. I think I'm less concerned about the immediate inflation risk, just given that we're likely to be in an extended period of just low global economic activity and demand, and it's very difficult for inflation to take off under those conditions. But one potential area where it might is just when you consider a lot of supply chain bottlenecks and certain sectors and areas where it might take a while for supply chains to kind of sort themselves out as certain factories go under and stop operating in certain countries or whatever the case may be. That's where you may start to see prices rise in certain localized areas of the economy that could potentially spill into the rest of the economy. So it's worth worrying about. It's, again, no one knows what exactly it would be or when, but the reason why it's sort of worth worrying about the debt and trying to come up with ways to draw it down at some point is simply to try to avoid a potential unfortunate situation in the future.
Hey, Chris, I see a question from Holman here. Can I take that? And then,
Yes.
Holman is asking, any hope for infrastructure spending in the near term, midterm? So this is a great question. Andrew Cuomo, governor of New York, and President Trump they actually can kind of get along, and you've kind of seen them having several meetings back and forth. And Cuomo is pushing hard for an infrastructure bill, and I actually could see, President Trump be more interested in an infrastructure bill with like a governor like Cuomo than I could see the Republicans in the Senate be interested, actually. So that's kind of an interesting dynamic. But I believe that that is one thing that actually could be political coming together on between, say, the president and Democratic governors. And there are, a lot of it is not so much turning on all kinds of new projects. A lot of it is avoiding the cancellation of existing projects. State and local governments got really behind the 8 ball. They suffered greatly, 2009, 10, 11, 12, 13, 14. It took 7 years for their finances to get back in order. They've started doing a lot more construction now for schools and libraries and roads and bridges and that sort of thing. And so the first thing I would say is do no damage. If we can prevent those projects from being canceled in 2020 and 2021, that would be a first thing that could actually be done. And there was a question earlier, something about things shovel ready. Well, those basically are shovel ready because they're already engineered and they've been approved. So part of the thing, I think, is just not canceling projects that are in process. So anyway, that's just a thought on his question.
Okay, I appreciate that, Rob, for you jumping in on that. You're right, there were a couple of questions about that, so yeah, worth getting an answer to. All right, so unfortunately, though, we are out of time. I want to thank Elizabeth and Rob both for being our speakers today. I want to thank everybody who's been on the Zoom webinar today. There have been an awful lot of you, so thank you. If anyone does have any questions in regard to the webinar today, please contact me. You can get me either by email or by phone. The webinar has been recorded, so you'll be able to get a recording which will be available tomorrow on the MSCI website. The slides from today's webinar will be distributed this afternoon, so you'll get those faster than the recording. And in 24 hours, you'll get another email from us that asks you to complete our post-webinar survey, which is important because we have actually created webinars and done topics on our webinars that you have suggested to us. So it's really important that you continue to tell us how we're doing and help us improve and find new topics. There will be another webinar next week. It'll be on Thursday, June 11th at 11 o'clock Central. And that's called The Psychology of Leadership. We have found retired Colonel Donna Brazile, who was the former Director of Leadership and Psychology Programs at the U.S. Military Academy at West Point. And the basic theme there will be how can leaders best foster a healthy way of interacting with both themselves and those that work with them. So I'm looking forward to that webinar, and I hope we get a nice audience for that. So on behalf of Keybridge Research, Rob and Elizabeth, and MSCI, thanks for joining us today. Have a safe rest of your day, and I hope everybody stays well. Thanks.
Bye, Chris.
Bye-bye.